So when it comes to what's working in the marketplace now with multifamily, and really what you should be focusing on, I would really kind of answer that question on what you should not be focusing on. And because what you should be focusing on, really, that criteria hasn't really changed at all. And what I'm talking about there are things like location, tenant mix, age of property, what kind of property is it? Is it converted? Is it not? And in many of my books, especially the 9-month investment, and especially going pro, in those books, I really outline what you really need to be looking for in terms of criteria, and that really hasn't changed at all. And so to really go over what you should be looking for, there's no real outlier here. There's no specific little niche kind of property or multifamily property you should be looking for. There's really not. And you can make an argument maybe in certain geographical locations that this kind of property is hot right now, maybe size-wise, or this location is hot right now, location-wise, in terms of maybe geographic. So you can make maybe some of those arguments, but at the end of the day, the criteria really hasn't changed. And I'm not going to take this version of this podcast to go over my criteria and all of the things that I really recommend you look into and avoid. Those are in my books. So you want that information, just go, you've got my books. But, for those of you that may be watching or listening, just go to daringarman.com and my books are there. Go to Amazon, and if you like paperback, you can buy books there. They're all there. And my criteria is there, especially in the 9-month investment, especially in paranoid banker investing, and especially in going pro as a real estate professional. So those really haven't changed. The other thing that hasn't changed is, and I'm bringing this up because I've had this question twice. Over the last 2 weeks, I've had it twice. And I'm going to bring it up and show you. You guys have seen it, but I'm going to show on camera the book. It's an old book. It is a Trump Strategies for Real Estate book, okay? But here's the difference, though. This is not a book written by Trump. The book was written by George Ross, Trump's attorney. Now, he's not his attorney now, of course, but, when The Apprentice was first getting started, and a lot of back in that era, and a lot of the deals that Trump was putting together and doing for a lot of the properties that he owns went through his lawyer, George Ross. Okay? So this is a Ross written book. This is not a Trump written book. Why is that important? It's important because Ross gives you unbelievably great negotiation, investing, due diligence advice. It's among the best I have ever read. Ever. Okay? And it's in this book right here. So, I'm not pitching the book. I'm not selling it. I don't care if you buy it or not or get it. What year was this written? Let me see here. I've read this twice. When was it? 2005. 2005. If you don't have the book, you need the book. Just on a conference, look at all of the pages I've got saved in this book. Can you see that? Let me get up to the camera. Can you see all the pages I've got saved in this book? For those of you who are just listening on audio, you're not privy to that, but I'm showing the camera all of the pages I've got saved in this book, and it's a ton. It's a ton. Raising money, techniques of negotiating. I could go on and on. Principles to follow, create the aura of exclusivity. This is some great stuff. And it's so applicable to everything we do as investors. This is everything from being real serious in multifamily like some of us are, or in other commercial real estate, all the way to, you're kind of a casual investor, but you want to be as savvy as you can be, this is a book to get, okay? Now, I bring that up because we're really talking about what should you be focusing on in a market like today? What should some of your criteria be? Well, one of the criteria really needs to be is to go in as smart as you can, as savvy as you can, and being the best negotiator you can. Now, that goes without saying. I mean, you want to be like that all of the time. I get it. But today, everything is so overvalued right now, it's hard to find a really good deal, isn't it? It's hard to find a good investment that you feel good about, that you're not hoping it works out. I mean, this is great marketing, by the way. This is great marketing. I wish I would have came up with the idea. I didn't. I love the concept that I see now everywhere of targeted returns. You guys have all seen this. Those of you watching and listening have seen this. If you're on any kind of email list, you're on any kind of investor list, they are sending you properties that they're looking at purchasing, developments, whatever it is. And what do they got on there? Big ass targeted returns. 16%, 18.2, 16.3, 17.4. Come on. Really? So you're really telling me that in an overheated, overpriced market that we have today, and by the way, just as an aside, I'm recording this in October of 2021, depending on when, people sometimes listen to podcasts years down the road, right? So this is what I'm recording. You're really telling me you're going to be getting an 18% return in an overheated market buying a beautiful trophy-like property. Come on. That's not going to happen. But by saying targeted return, that word targeted, there's no warranties, there's no guarantees, there's nothing like that, and they could be off 18% and still be okay. All right? So, I'm picking on those folks that do that a little bit, admittedly, but I'm saying it because one of the things that you need to really be looking for in this market, in terms of criteria, it gets back to this book, it gets back to going in savvy with some wisdom, knowing that everything is now hyper-marketed, hyper-oversold right now. And I say everything, it's not, that's not accurate, it's not everything, but it's close. It's close. So the first thing, going into the market today, you got to be smart in terms of being disciplined. Okay, answering the 3 questions. What is it you want? Okay. Why do you want it? Okay. And looking down the road 5 to 10 years at least, who will benefit from what you want? Okay. What do you want? Why do you want it? Okay. And who will be benefiting from it 5 to 10 years down the road? So you ask yourself those questions, you'll be getting answers in terms of return, types of property, income, cash flow, resale. So all of a sudden it starts to create kind of a cascade effect, kind of a pyramid effect, in a way, because you start kind of building it up, and that's what you need to do. Okay, you shouldn't be going out there like this. Well, yeah, I got 200 grand to put into something. I'm just looking to put it into something that looks decent. That shouldn't be. And by the way, I understand that. I understand totally. But there should be more thought going into it. So number one, it's understanding the forethought you should have before going into an investment right now in owning a multifamily property. Now, having said that, I'm not advocating spending 6 months spreadsheeting the crap out of something to see if you like it. You got to be making some pretty quick decisions here. But you don't want to be making careless decisions, okay? All right, so that's number one. Just be wary and let your intuition really be talking to you. Let that voice inside really be talking to you right now. Because, yeah, there are good value-add properties out there. Yeah, there are good opportunities out there. But there's this many of them. There's this many. And if you get an email from the same company especially come across your desk once a week about how this deal is so great, oh, well, next week this deal is really good too, oh, the next week this deal is really good. Come on. There aren't that many good ones out there. And I don't care what kind of geographic spread we're talking about. There's just not, especially right now. So just be mindful of that and the forethought and wisdom you need to be going in, especially when it comes to things like negotiating, preparation, and thinking through what your voice is telling you about a certain opportunity. Okay, that's number one. Number two. Number two is not adjusting your patterns, your decision making, and your goals just to fit a property in order to get involved in investing in it. Okay, so in other words, that's a long way of saying don't be shifting your criteria in order for it to work for you. Okay, don't be shifting your criteria. Now, I'm all about not being totally rigid. I'm all about being flexible. Okay, so and this is right, theoretically, you always need to be kind of evolving and thinking and changing and deciding, and you don't always want to get totally locked into the same exact thing year after year after year after year. Now, if you've got a recipe that you followed like that that's been good, fine. But you want to have a little flexibility. But you don't want to be totally throwing everything to the side in order to just get into a deal, into a multifamily property, or getting a deal done. And I'm seeing this happen now all the time. So in other words, I'm seeing individual investors, I'm seeing companies, I'm seeing partnerships, I'm seeing them going into the market with pretty much a manifesto of what they want to achieve. Here's the kind of properties we want to buy, here's the kind of returns we're looking for, here's what our expectations are, here's our, et cetera, et cetera, et cetera. Okay? Only to find that they shift from that just to get a deal bought, just to what the language is today, win the deal. Because in many situations, there's competitive bidding going on out there. So all of a sudden, they go into an opportunity, a multifamily opportunity, with thoughts and goals and targets in mind, only then because they want to now win the deal to change all of that. And that change involves one word: hope. Hope. Okay? So there's a difference between going in with a plan and hoping that the plan works out versus discarding the plan and hoping that it works out. Okay? And that's what a lot of people are doing right now. And you can't. Just think of it this way. There's always another bus coming. There's always another bus coming down the road. So, yeah, in today's market and in today's world, that bus might be 2 months down the road until another good one comes up. It might be 4 months down the road. Hell, it might be 6 months down the road. So what? So what? Yeah, Darin, but geez, I wait another 6 months, prices are going to continue to go up, et cetera. Look, that is not strategic thinking, that is panic thinking. Let me ask you a question. Do you think that real estate values, especially multifamily, are going to continue to go up and up forever? From here into eternity. Here until I leave this earth, do you think values are just going to go up month after month, year after year? No, they're not. If history has shown us anything, it's shown us that there's spikes There's upward trends, there's leveling off, there's downward trends, there's upward trends, there's dips, there's all of that in almost any investment. And real estate's not immune to that. So you can't be thinking, oh, well, if I sit on the sidelines, I'm going to miss out on these. I'm paying, they're going for $100,000 a unit now. Geez, if I wait 6 months, they'll be going for $150,000 a unit. So what? You'll be losing even more money 6 months from now. So be smart about that, okay? And it's so tempting because you can really justify it. But just be thinking about that. All right, here's the other thing. The next thing related to that. You've got to avoid investment pressure of getting capital in the market, of getting your money in the market. Whether it's your own money, I mean like you. So, you've got your money set aside and you're waiting for that property to put the money in. And you're grouchy because you're not making really much of any money. And in fact, you're probably really losing a little bit of money based on where your money is sitting right now, right? Right. So you've got this internal pressure on you, as what many other people do, to get that money in out of where it's at now and into the market. And, oh, good, I got it in the market now. Well, that's not really why you invest, is to relieve the pressure off of you. You invest to make a profit, hopefully a large profit. Has nothing to do with how you feel emotionally, but yet that's how a lot of people are behaving. They're behaving emotionally because they feel they need to be getting their money from point A into the market at point B, and they're willing to take on the risk, or maybe not even want to think about the risk involved in that, just to get their money into that investment. Okay, well, once that's done, then what do you do? Okay. Once you get the phone call of, well, yeah, our vacancy's up and our values are going down, and oh yeah, that distribution we told you we'd have for you, well, it's not really going to be there. Once you start getting that information, you're going to then start thinking, yeah, maybe I liked having that pressure on me when it was sitting in that, money market account or savings account, right? Better. So don't let the pressure on you force you into an investment just to get your money into it. And we're talking multifamily now. The other thing goes to if you've got partners or you've got other people that are investing with and through you, because, I get emails and calls every day isn't accurate, but almost every day, from my partners, other investors saying, hey, when are we buying something? When can I get my money into something? My money's sitting here. You told me you thought we'd have something by now. I got lots of pressure on me right now from investors, my own partners, saying, Darin, come on, we got to be buying some stuff here. No, we don't. Only if it meets our criteria that we've already pretty much talked about before. Yeah, hell yeah, we'll jump into it full throttle, man. I'm there, and we're going for it. But if it doesn't, I'm not putting our capital, your capital, in the market in a property that I don't feel good about if I can't go back to you and say this is a good property to buy. I don't want to go back to you and say, yeah, you know what, Bill, we finally got your money in a property. I don't care. I want to go back to you and say, you know what, Bill, we finally got your money in a property you're going to absolutely love. It's going to be great. But until I can say that, I still got that pressure on me that Bill wants to get his money in a property, and I'm not going to put it in a property just because I got Bill and 25 other people calling me, telling me to get their money into property. Because here's what happens. What a lot of people then think is, well, all of a sudden my partners are going to go somewhere else. Well, they might. They may choose a different investment. Well, they might. But again, those are no reasons to be getting involved in getting deals done just for the sake of getting deals done. Okay? And here's the last one. And not a lot of people think about this. And I don't mean to come across like I've got like this some big secret. Oh, nobody knows about this. But what I'm going to tell you, it's going to make so much sense to you, but I promise you don't hardly ever think of it. And it's simply this. If we've been taught anything as just general investors, it's really to make sure you spend the majority of your time doing what most everybody else is not doing. In other words, you want to be doing the opposite of what everybody else is doing. Okay? So, if you look at me, so what's my philosophy right now? My philosophy is to continue to drill and find great multifamily properties that we can own. I'm still on that track, right? As long as it meets our criteria, and as long as it can be an investment that our partners know meets our criteria. What's everybody else doing? Everybody else is doing, oh, we're just going to get out there, competitively bid, buy something. Oh, great, we've locked up a property at $125,000 a unit. We feel great about this, and we're just going to go forward. So what most everybody else is doing is bending their criteria or even ignoring their criteria in order to buy something and have something that they own, versus the opposite, which is sticking with what has been working and only looking at and dealing with those kind of properties that work and that meet your criteria. Okay. In other words, I mean, in a real general way, everybody's out there buying and overpaying for stuff. I'm not. And I'm not doing it just because everybody else is. And if there's one thing that we've been taught as investors from, like, historically, it's been to think and do the opposite of what everybody else is doing. Okay. And again, that's not to say that we're still not looking. We are. We're still not going to buy. We're going to buy. So we're still as aggressive as we possibly can be. But we're not carelessly aggressive, which is what everybody else is doing right now. And when I say everybody else, I don't mean everybody, but 90%. I mean, I'm blown away at what properties are going for right now. And it's all based on hope. And pretty soon, once things the can only get kicked down the road for so long. And I want to be in a position, as I've said before, and we will be in a position to have conversations with people that find themselves in a bad position because of hope and because they wanted to win the deal. Okay, so when it comes to you, your own criteria, what you need to be thinking of and looking at, I really suggest you think about what I've just talked about. What it will do is it will create a huge amount of free time for you. It will, because now all of those properties that cross your desk that you pretty much have dug into, you've gone under the surface and you've looked into it, you already know, oh geez, I mean, I can't figure that out. Next. It's not, well, I'm going to spend 3 days spreadsheeting this to see how I can get this to work. You've saved yourself 3 days. And what's good about that is you can now look at more deals versus spending your time on that one. Okay? So, moving forward in the market, what are some of the things you should be looking for? Those really haven't changed. Again, go to my books, check them out in terms of what we're talking about there. I really want to talk about some of the things you don't want to be doing that everybody else is doing, that you don't want to be joining and getting on the bandwagon and doing. I want to finish my podcast with a story that I've told a couple of times, but I'm seeing it being played out in the multifamily arena a lot now. And it's my trip to Orlando story. So back in 2007, and I'm going to preface this by reminding everybody, because some people that watch and listen, they're young, so they don't remember this. And some people remember, but they forgot about it and want to forget about it. So 2007, the real estate crash started in huge waves, especially in the single-family home market, especially in the debt markets. Many companies went under, many banks went under. So long story short, we had a real estate crisis that lasted 4 years. House and property valuations in many parts of the country were cut in half overnight. I mean, all of those kinds of bad things. So this is right before this happened. So this is 2007, months before the crash. I'm in Orlando at a conference, and I'm getting out of the airport to get into a taxi. And I'm talking to the cab driver, just making small talk. Where are you from, and what are you here for? And so I told him I was here for a business conference, mastermind conference, business owner conference. And so, of course, he jumps into, well, what do you think of real estate? And I said, well, I'm in the real estate business. I like real estate. So he starts telling me that on the side, he's flipping condos. He's flipping condos. And so he drives taxi and he flips condos. And how great it's going for him and how much money he's making doing this. Now look, if you're a cab driver, whatever you're doing and you want to flip condos on the side and make money, God bless you. God bless you if you can start doing that full time, and that's what you do if you don't want to be doing your cab driving or whatever else you're doing. Go for it, okay? However, the red flag starts going up when I've got a guy that's telling me that he drives cab and he flips condos. Then I ask him how long he's been doing it. He tells me about 6 months. About 6 months, and all the money that he's making. So I get out of the taxi cab, having a nice conversation with the man, pretty much knowing that there's definitely some problems out there. I knew there were some problems. Did I know it would be the degree it was? Of course not. But I knew that we were in trouble. I knew we were. If the cabbie is telling me how to flip condos and make money and why I should be doing it, and he's only been doing it for 6 months, you already know. So, what's my analogy? That's my analogy to what you see today. I see dozens and dozens and dozens of investors that are starting, overseeing, and running real estate partnerships in a big way that have absolutely no experience. But they're going out into the market with no experiences of owning, managing, going through bad stuff, no real world experience of how to really deal with really bad things when they come up with properties, big challenges, huge speed bumps or hurdles. And they're going out and they're overpaying for properties with little or no experience in this field. Reminds me of my cabbie friend. How much money they're raising, how much money they think they're going to be making, how much money they're making on the fees and raising the money and buying the properties, which, by the way, God bless them, that's great. But there's no substance backing that up. There's no experience backing that up. It's one thing if you've got a shit ton of experience backing that up. But if you don't, oh boy, it's going to get interesting, as they say. I was interviewed by a couple people on podcasts that, they're about the age of my kids, which again is fine. But in asking them how much experience they got and what they've done recently, they really don't have any, or it's less than a year old. And while I admire the entrepreneurial spirit in doing all of that, I am fairly alarmed at the ease at which this is getting done without earning it. Does that make sense? Earning it. Interesting. And so, as an aside, that's maybe another thing to be thinking about in terms of who you deal with. How much experience do they have? Have they been through some good things? But you also want to know, have they been through some bad stuff? Because in any kind of business, you don't really learn experience based on when things go good. You learn things when the shit hits the fan is when you learn stuff. It's, going through difficulty and challenges and adversity. That's how you learn. That's how you get experience, right? And so one of the first things I tell people when they ask me, have you had any properties that went bad? Hell yes, I have. Oh yeah, more than one. Happy to tell you all about it if you want to know, because it happens. But those are some of the things you got to be thinking of in terms of not doing. Okay, not doing out there. And if you follow some of the things that I've talked about on this episode of this podcast, you're going to find yourself in a much, much better position 1, 2, 3 years down the road than if you just jump in, get taken by the tide, and just land somewhere just for the sake of getting your money invested. Okay? All right.